Hey, welcome back to Bricks with Tips. My name's Tayo Oguntonode, co-founder of Bricks with Tips, which I run with my wife, Antoinette. Bricks with Tips is a channel dedicated to helping you guys achieve your property goals and get better with your finances. And today we're going to be talking about joint mortgages, the good, the bad, and the ugly. Now guys, to give you some backstory, the reason why I've decided to make this short video on joint mortgages is because, well, there's a number of reasons, right? One, properties are extremely expensive now and they're getting more expensive. B, a report by Halifax found that 6 out of 10 first-time buyers were buying with someone. So if more and more people are considering buying with someone, it's better to be educated. And C, when it comes to investing, if you're an investor, not a first-time buyer, collaboration is not something that is new. It's something that is celebrated in oftentimes, and it's something that you definitely should consider, especially with people that you trust. So without further ado, let's get into it. Why would someone do a joint mortgage, right? Why wouldn't they do a joint mortgage? Sometimes when you go halves with someone, right, people are often thinking about the negatives. You always think about, I have to split the profit, or if you're buying a home, I have to split equity, or if you're buying a home as well, I have to split my space, right? And all these things are true, right? But quite often than not, I always give the example, 50% of something is better than 100% of nothing. And in all of these scenarios, equity, profit, rental income, space, you're talking about things that you didn't have before, right? These are all added benefits. These are all benefits, right? So you're always getting something. And the reason why I'm passionate about this is that not only in property, but even for myself, some of the businesses or best businesses I've built were in collaboration with people, right? Working together works really, really well. Even businesses that I haven't built, some of the greatest things I've done required collaboration. And what you'll find as well is that there's collaboration all around you if you look hard enough, right? Some of the biggest CEOs of businesses that you know, Jeff Bezos and Amazon, go and research how much they own of their business today. They understand that collaboration is key. Go and research how much they do on the day-to-day. They have experts that are better than them within their business. Anyways, I digress. Let's bring it back to property. Quite often than not, people are scared of splitting the benefits. But the good thing is as well is that you get to halve the risks, right? So not only the risks, but the things that you have to pay for. So when you think about it, if you go halves with someone, you pay half of the mortgage. You split the cost of the repairs. You split your time that you have to attribute to the property or dedicate to the property. You double the knowledge. You double the attention on the property. You double the amount of eyes that are looking at the deal. You halve the deposit. You may halve the time that it takes for you to buy the property. You split the mortgage fees. Like, guys, you can see that there are loads of benefits of it. But in order to benefit properly from it, you need to get it right. So let's get into it. The good, the bad, and the ugly. As mentioned before, when it comes to first-time buyers in particular, we can't ignore the fact that so many first-time buyers are buying together. And we often give the example, apologies if you've heard it before, but a lot of people that are waiting to buy their property 100%, they might live with their sibling currently, who they're living with anyway, and both of you are wanting to forge your own journeys. But what you can do is you can get on the market quicker, buy together, your living situations will be better because you're sharing a house with less people potentially, and you can build equity together. You get to halve the risk as mentioned before, halve the mortgage payments, your deposit gets doubled, and quite often it can just shorten that timeline for you to buy your first property. Now, as you know, Antoinette and I have spent about 10 years in the property game. We spent about 7 years helping people within property. Actually, more than 7 years, maybe about 9 years, because I used to be a mortgage broker. And we've managed to see so many people that have bought jointly, then split their equity, gone their separate ways, and then gone about building their own property journeys individually, right? Because it's all about beginning. As you probably would have heard before, that once you get on a property ladder, everything gets a lot easier. These benefits of going joint can allow people to access properties that they thought were out of their reach before. So if you wanted to buy in a major city, London, Manchester, you could say Birmingham. I'm joking, but major cities across the UK sometimes are hard to access. Buying jointly can help you and has helped many people. But if you're working with someone that's like-minded, somebody that you trust and somebody that's serious, somebody that shares the same values as you, sometimes working with them can bring the best out of you, right? It builds accountability. Let's talk about an investment, for example. So quite often than not, if you are invested with someone, you might do more research because you know the other person is on job like you. So you might put in more work than you would on your own project because you understand that you're working with someone and you need to maintain the same standard that they do. And they're going to be thinking the same thing about you. And sometimes, you know that old saying, iron sharpens iron. And quite often than not, that does happen when you collaborate with someone. So the good is quite evident, right? Let's go into the bad. I know you guys are waiting for the bad. Let's go into the bad quickly. The bad is quite easy to understand, right? The first is you're financially linked. So if they miss a payment, your financial record, your credit can be affected. This also means that if they are no longer interested in a deal, so if you buy a home and they decide that they want to move country and they want to just stop paying the mortgage and you're half in it, then you are both 100% liable. So your credit rating will still be affected and you could end up defaulting on the loan if you don't pick up their half in that scenario. The next thing is that the property purchase is based on someone else. So everybody needs to agree. Everybody needs to agree when to sell. Everybody needs to agree when to remortgage. Everybody needs to agree when to rent it out. You're stuck together, right? It's interesting, right? I know I'm speaking about the good, the bad, and the ugly. We're on the bad, but yes, there is a level of commitment, right? When you're getting a mortgage with someone. So it's like a commitment, like a relationship. And if a relationship breaks down, a platonic relationship, a romantic relationship, that mortgage is still going to exist. Now, the property can be sold, which will make that legal relationship break down. And sometimes that's the reason that people don't want to buy property. But I don't know, I feel like we go through a lot more things that are more permanent than that. For example, having children, right? But yeah, I'm going to go off on a separate topic. So I'll just leave that note there and let's move on. Uneven contributions can create tension, right? So if some person's putting in more work than the other or more money than the other, unless it's been legally documented, it can create tension later. I would say that kind of concludes the bad. Now, the one thing I want to note is that there's two main things where the bad is concerned, how you can counteract that, right? The first one is, and I know you can't know everybody, but there are risks in life in general, but kind of have some kind of track record of the person that you're doing business with. So the reason why I mention a sibling is that you know what your sibling's like, right? You've lived with them for a number of years. If you want to get a mortgage with them, it's going to be more than 18 years, right? Or you've known them for 18 years, hopefully. Now, in that scenario, you kind of know what they're like. You might have an idea of what their finance background is like, right? The next thing is to manage expectations, right? People change. And when I say people change, I don't mean in a negative way. It might be as simple as when you bought your property with your investment partner, you didn't know that they were planning a family. And now they've planned a family, their financial circumstances have changed. And I always mention, if you managed expectations in the beginning and said that, look, we're not selling this property for at least 5 years, are you comfortable to continue on that basis? Things wouldn't be awkward at a later date. So very, very important to know. Now, the ugly kind of consists of what could go wrong if the bad gets worse, right? So let's look at a few things. One person can't or won't pay their share. Two things are typically going to happen, right? You're going to pay the full amount, or you're going to default, credit rating ruined, and the house is going to be repossessed. Too many people buy together and they don't document things. So maybe someone put in 75% of the deposit, and they thought just because they were making a legal process or purchasing a property, or it shows in their bank statement, it was being documented. No, you need a declaration of trust, a legal document that states that that was put in at the time of purchase and what that means. And it's fine to do this in a friendly relationship, right? Your people that you're working with will respect this as well. We mentioned things could change. What happens if someone gets married, someone moves country? Unfortunately, what happens if someone dies? Like, it's crazy. If it's not clearly outlined in the agreement, it can become a financial nightmare. You kind of want to make sure that both parties have things like life insurance in place. You can do that together. You kind of want to make sure that the ownership has been cleared as well. So what I mean, is it a joint tenancy or tenants in common? Joint tenancy and tenants in common focuses on survivorship. A joint tenancy basically means that you both own the property fully. What I mean by that is that if person A and person B own the property together, if person A passes away, sadly, person B will own the property fully. Now, that relationship works quite well with husbands and wives in particular. Sometimes it can work well with siblings as well, siblings that don't have families. Now, if someone does have a family and you're buying with a friend or so on and so forth, you kind of want to go for tenants in common, but also get legal advice. But tenants in common means that you own it 50%, complete split, or whatever the split is. But in the example, we'll say 50%. Person A owns 50%, person B owns 50%. Now, if person B dies, what happens is that half of the property passes into their estate. So whoever their beneficiaries are will own half of the property. Now, you also want to document what that could look like as well, because what does their beneficiaries want to do? Do their beneficiaries want to sell the property? Are their beneficiaries happy to keep on receiving rental income if it's an investment decision? So these are the things that you want to think about as well. So guys, hopefully this video was just like a thought triggering video, something to kind of think about, the good, the bad, and the ugly. Based on everything I've said, would you buy jointly with someone? Please just say yes or no and the reasoning below, right? I'm really, really interested on hearing this as well, because a lot of people that consume our content, a lot of the time they're very against buying with someone. But it's one of those things, right? You can't ignore the fact that 6 out of 10 first-time buyers are buying with someone, right? They often say that success leaves clues, and that sounds like a big clue to me. The next thing is that the bad and the ugly stories are always the ones that we focus on. And you know what they say? Nobody hears about planes that land safely. I'll say that again. Nobody hears about planes that land safely. And what I mean by that is that nobody hears about all of the people that have had pure success from buying with someone. Once again, hopefully this video helps you to think about it. Please let me know in the comments below if you would consider buying with someone. Please like and subscribe if you haven't already. And we'll see you on the next video. Peace, guys.